Welcome to the Phil Vogel podcast. I'm Phil, and this is the only podcast focused on dealership mergers and acquisitions. And we also discuss the business of the automobile business because that's my business. I do dealership buy-sells. Most often it's a broker role, but quite often I'm a dealer's wingman during transactions because, well, I've been there and done that. As a third-generation car dealer myself, I've been advising dealers and selling dealerships ever since I sold the last of our stores in the early 2000s. So on this podcast, we talk with dealers and industry thought leaders that are making a difference, and creating the future. We talk transactions and all of the elements, news and trends of the business that relate to creating value for buyers and sellers. Most of all, we want this to be a place where we can have some fun, share some great content, and have awesome guests. So before I introduce this show's guest, I'd like to thank and introduce you to our show's title sponsor, Tekion. Now, Tekion's a new kind of DMS. In fact, it's way more than a DMS. Tekion is an automotive retail cloud. If you haven't heard or seen Tekion in action, I promise you will very, very soon. Tekion's a single platform that digitizes and runs your entire business and also allows complete integration with third-party ecosystem partners with zero integration fees. Tekion's AI engine gathers insights and personalizes both the consumer and dealership team members' user experiences, smoothing out any friction points that arise. Increased profitability as a result of Tekion's machine learning algorithms, personalize upsell and cross-sell opportunities. Tekion has multi-dealer, multi-OEM enterprise views that deliver actionable performance metrics and KPIs. And here's the best part. Zero third-party integration fees, as I said. Unlimited data access. And the data, it's yours. That's right, you own it. The icing on the cake, you can cancel anytime with 30 days notice. Yeah, you got to check out Tekion today. Tekion.com. Over the last 2.5 years, Foundation Automotive Corp has grown from 1 dealership to 21 dealerships in Canada and the United States. Today, Foundation's president and CEO has agreed to join the Phil Vogel podcast. So, without further ado, I give you Kevin Kutschinski. Welcome, Kevin.
Thanks, Phil. Thanks for having me.
Welcome to the show. Where did we catch you today? Are you in Canada or are you in Houston?
I'm south of the border. I'm down in balmy Houston today.
Is that right? How is it down?
Yeah,
it's balmy?
It's pretty nice. It's I think it's 82, 83 degrees compared to Canada's probably mid 40s. So it's a good trade-off.
So let's start at the beginning. I think it'd be great for our audience to hear a little bit about you and how you got into this business. And then if you could tell us in your journey and tell us a little bit about how, why, and when what was the thought process with starting Foundation? And then if you could tell us a little bit about your structure as well, that'd be great.
Yeah, glad to share that with you. So I started the car business back in 1987, so I'm going to age myself a bit, but just out of school, looking for a job. It was tough to find something, and I had a friend working at a wholesale auto auction, so I started selling there. Within 3 months, I was sales manager. Within a year, I was co-managing the auction with them. And a couple young guys, just full of vigor and a little bit of hope. And we ended up turning it into a very large volume auction. And throughout the couple of years that I was at the auction, I got recruited by a bunch of different dealerships, whether to be a used car manager, a new car manager at a smaller metro store, or a partner at some more rural stores. So the best offer I had was to become a managing partner at a Chevrolet Oldsmobile Cadillac dealership in Milesdale, the Alaska Highway. So my folks didn't have any money, and graciously the family, who are like family to me today, offered me 10% equity, and I had to pay it back the profits. So we paid that back very quickly, and then bought the balance of the dealership that I was allowed to buy within a fairly short period of time, and just grew the business. I didn't know. It's funny because I didn't know how to order a new car. I didn't know what F&I was, but I knew used cars very well, obviously because of the auction. I knew how to manage people, but it was a little bit of education by fire, and I ended up going to dealer 20 groups. Went to GM University, and just kind of I didn't know what I didn't know, so I learned I learned kind of some of the tricks of the trade, so to speak, and just worked really hard. And ended up being in the number one dealer 20 group in North America for Performance Incorporated, which was
Right. I was reading about that. I saw that. In which store was that?
That was a Chevrolet. Ended up just being a Chevrolet Oldsmobile dealership in Dawson Creek, British Columbia. So very profitable store. I was the top dealer quite often in the group. Very, very strong dealers. By no means was I the best dealer in North America, but just a really strong dealer and a strong group. And we picked each other's brains and we held each other accountable. We just didn't allow sponges to come into the meetings. We wanted people who are going to contribute, and I attribute a lot of my success and the success of dealerships, to those relationships I formed in those groups.
So, all right. So, talk about the timing of foundation and the last 2.5 years. I mentioned in your introduction. I mean, you have. I mean, I think you win the record. I mean, I think you're based. Your entities, but you guys are based in Canada. But as you mentioned a minute ago, you're moving to Houston. We can talk more about that. Your office is in Houston. But how did you get into, when did you decide, and how did you decide to form this group and grow at this pace that is, I mean, that's a lot of dealerships in 2.5 years.
It is. We'd because I love the dealership space. We were very successful at it. We owned quite a few dealerships. We owned RV dealerships, rec vehicle dealerships, and beyond that, other businesses that we'd started. So really knew how to start deals, structure deals. And when my partners and I ended up selling dealerships in 2011, 2012. I retired for about 5 minutes and then got into the acquisition, divestiture, mergers and acquisition, and had my own finance company. So really got into that space. Learning how buy-sells worked, understanding kind of the ebbs and flows and the emotions of the vendor and the seller, or the buyer, I should say. And then so I watched in 2015, 2016, there's some consolidation going on in Canada. And I love the auto space, and I really missed it. I wanted to get back into it. So lo and behold, 2017, I started Foundation Automotive. And I started with the back end first. So I started with all analysts, accountants, because I know how to read a financial statement. I can understand opportunities, but I want to make sure that the diligence and the numbers we're getting are accurate. So I hired all analytics in the back end to begin with. So we actually bought our first store in September of 2018, and that was in Squamish, British Columbia. And then it's been a fairly torrid pace since then. In November, we closed a dealership in Drayton Valley, just outside of Edmonton, Alberta. And then we had our first Texas acquisitions in June of 2019. So since then, like I said, we're at 21, and we anticipate to close another 16 dealerships this year.
Well, okay, that was a question I was going to ask. Another 16 this year. So what? Obviously, it's been a cakewalk opening up 21 dealerships in the last 2.5 years, right? I mean,
yeah, my hair used to be black.
I was going to say, so 16 more this year. So over the last 2.5 years, you had all these stores. So what challenges did you run into? I mean, it's one thing for like a public group like a Lithia to pull down like 12 stores, right? They've done it plenty of times now and integrate, and they've got integration coming. I mean, what challenges did you run into over the last 2.5 years?
Oh, we had every possible challenge you could imagine. The benefit is that I think if I've got one skill, and maybe I got one or two more than that, but my main skill is to bring the right people on to be part of my team. And I was able to partner with Chuck Kramer, who's my COO, probably one of the best car guys I've ever met in my life. I thought it was pretty good until I met him. So you get a guy like that knows the operations inside and out. It really takes a lot of weight, the weight of the world off my shoulders, particularly. I have an accountant, or our CFO, I should say, that was a CFO on the Toronto Stock Exchange. So here's a guy that literally his house can be burning down, and he'll still, stay cool, calm, and collected. Right. As us as car dealers, we're the ones more likely to pull the fire alarm and want to do something drastic. So it's nice to have all these kind of different personalities to help you through the process.
So you mentioned your partners, and what an interesting structure. I want to know more about your kind of corporate structure. You talk about your CFO but talk about, when we talked the other day, we talked a little bit about the structure, your operating partners, and your approach to that, to your organization. So can you speak to a little bit about the structure with bringing on, I mean, with, again, the growth, everybody likes deal flow, and people on this hear me on this show talk about it, but I also talk a lot about people flow. And so you mentioned it, and you're obviously got to grow organically and throughout the outside, but of your people, that is. So talk a little bit about the structure in your stores.
Well, the genesis of our whole structure was based on a lot of my experience. So,
Mm-hmm.
as I mentioned, young kid in Canada, I was 23. They recruited me at 25, and I had no money, and my folks had no money. So I really didn't have an opportunity to get into the car business unless I had somebody to help me. So the way that I looked at it was, you think about the million promises that are made in the car business on an annual basis. Next store I get, I'm going to give you this store. I'm going to make you a partner.
Right.
Or
Never
go
heard
find me
that
a store and I'll
before.
buy. Yeah, no, nobody's ever heard
Right.
that. And then
I didn't have an idea.
go find a store. Go find a store and I'll finance it for you. So everybody's had these broken promises. So I figured there's going to be a New York phone book full of people that have had this experience that are going to be really good quality people that have access to a little bit of capital if necessary that can come in and do that. And that's how we structured it, based on my experience, based on Chuck's experience. And we figured those are going to be the best people to get as partners because and don't take this the wrong way, but the people with PhDs sometimes don't understand what it takes to grind and to set up a line of credit on your house to make payroll. They don't understand the grind where you can't pay yourself 1 month because business is tough. So it's different when you get people that actually went through the grind, and that's a big part of our philosophy is that. And then not only that, Phil, but we when we buy a deal, obviously we lever it, we lever it, but we lever it to a point of comfort for us and the bank. And we let our partners buy in the exact same value we buy in at. And we also let the partners buy in the real estate, which is extremely unique. Most dealership groups will not allow a partner buy into the real estate. We share everything. We don't bump any pricing. We don't bump any valuations on property, assets, inventories, nothing. We come in at the exact same value. And that's
Right.
part of our philosophy has always been about fairness.
Right. So I mean, you're taking what worked for you, right? And it was successful, and I think that it's a unique, I don't know if it's unique, but certainly dealers I talk to have got partners, I mean, I think bringing them in at the acquisition level and sharing on the real estate, having them part of that as well. I have not heard that. But I certainly, think that is going to be a very attractive platform as you grow. I would think people that are watching this and people that are hearing about your growth and what have you are going to be more inclined to at least talk with you, and because there's a lot of competition for people these days, right? And you've got a pretty solid model. So, but what my experience with people and that flow is, you mentioned your business philosophy a little bit around the equal shares, but talk about the culture a little bit, not just with your staff, but with your staff, but also the culture that you are fostering for customers and consumers.
Well, our philosophy has always been we're very customer satisfaction oriented, customer experience oriented. It's the old mantra that you treat people the way that you expect to be treated. So, we've never had an issue with CSI. We've always been kind of top of our group. A majority of stores that we've recently bought, times have struggled, and we went in and now we're top of zone for sales efficiency, for sales effectiveness, and that's part of the culture. Is we expect to be the best. My partner Chuck always says we expect more than our fair share, and that's not being greedy. It's just that we want to be the top of the heap. So, but as far to get back to the original question about the customer experience, we really spend a lot of time and a lot of effort on really expanding that customer experience, and whether that be through social media, recognizing customers, giving customers right opportunities, treating them fairly, I should say. We do a plethora of different things. We've got a partner of ours in Madisonville, Texas, Eric Barbosa at our Henson dealerships. And I believe he's the number one social media dealer in the U.S. So here's a guy that's he's got 3 videos of had over 7 million views each. And it's not just us trying to sell cars; it's us being part of the community. We give away a free car every month to people in need, people that can't otherwise afford it.
Dealership or at as a group?
Just at that dealership alone. We also give away a free car up in our MedVed dealerships in Denver as well.
Colorado.
We plan on doing
Right.
it on all of our stores, but it's for people that don't have the ability to get a vehicle themselves, and we want to help them. We want to be part of the solution.
So you give away a car every month at every dealership?
No, we're doing it right now at Hanson. We have since day one. We're doing it every month at our MedVed stores. We're going to start doing it at our stores in Castle Rock, Colorado, and we're going to expand it to all of our stores.
Wow, that's awesome. So let me ask you, you talk about people, talk about deals. Which comes first, the deal or the partner?
Maybe expand on that. So as far as the deal for the acquisition, do we look for the partner?
Yeah, I mean, to your point, when we were talking about the kind of what the stories in the business. Oh, the next deal I'll sell you, I'll bring you in on that deal or what have you. But so when you're looking at a deal, again, with this breakneck pace of growth that you've got. So when you look at a deal, do you look to grow a person and then go find a deal? Or are you looking at deals and then try to find the right person to fit?
We're a little unique in a sense because we've got the way that we do all of our deals. We'll get something on paper. To be fair, we've looked at over 1,000 rooftops, so we're very diligent, go through a bunch of different processes. But once myself and Chuck or Derek, our CFO, decide that's the route we want to take, I insist on, after we've done our initial diligence on financial, that I go meet with the vendor. Because to me, it's so important to find out what the culture of the dealership's like and what the culture within that vendor or the owner is. And there's been lots of times we met with people and it's just not going to be fit for us. And not because they're bad people, but we don't know if we can make improvements in that culture or if it's just something that we don't necessarily think we can fit into. So what we'll do is, first of all, we'll go identify if we think that's the right culture for us and the right group of dealerships. And then at that point, we dig in deeper with our diligence, make a fair offer. And then at that point, then we start looking for partners. So having said that, I'll contradict myself. If somebody comes in and they want us to look for a store, or they've got a store available and he's the right partner, we'll also take that route. But that typically hasn't been our process.
So with regards to that, going back, you mentioned your due diligence process, and that's a question you brought it up, I'll ask you now. So when you're looking at a deal, analyzing a transaction, and somebody brings you a transaction or you're looking at one, so are you looking for, is the due diligence that you do, are you looking, do you have a business model, like a profile that this is the deal and this is our acquisition profile and this is our kind of our return on investment that we're looking for, or this is the max we're looking to do on a multiple of earnings, or even addressing kind of earnings? I call it COVID, the COVID earnings that everybody's experiencing these days. But so I'm curious as to what that looks like for you, for Foundation.
Yeah, so I guess it's not really a secret sauce, but without us giving away too much, I think that we definitely have a range for EBT, and we're very disciplined. We won't go outside of our range. So we look at stores typically that we think have got, let's call it a range between 15 and 40% upside. And that's a visual upside between, is their service absorption a lot lower than we think it should be? Is their sales effectiveness 65, 70%? We think we get it to 100%. Or their F&I numbers maybe a little bit weaker than we think they should be? Or are these great performers? So there's two different strategies. So if we think that there's that upside, we'll buy it, bid on it based on what we think that upside should be and pay a fair multiple. And if somebody's really a top level performer and person's, you're running a Chevy store in doesn't matter where, and you're 5% net to sales, I don't know if there's not much more we can add to that store. Right. So at that point, we have to look at maybe paying a slightly lower multiple to hit the target IRR that I have in my mind.
Right. Okay. So you're working with an IRR and that type of thing, and I got you. That's good. So with regards to acquisitions, so you were started in Canada, you're in the U.S. now. And you mentioned, before we started the show, that you've relocated your headquarters to Houston. So tell us a little bit about that, and that relocation, and what does that mean for the group?
Well, it means for us, it means a lot of growth, a lot of expansion. I like the creativity of U.S. deal flow compared to Canada. The multiples can be slightly fairer. I think they're pretty similar, but I'd say slightly higher in Canada. But we love Texas. We've got, we moved, geez, I'm going to think 6 or 7 of our staff from Canada down to Texas, and they're all now assimilated, and I think they're all saying y'all now. So we're
y'all.
we're yeah, y'all. We're here to stay. And
All
we
y'all.
we love
Yeah.
we love the U.S. and we love where we're at. So, and we want to expand within Texas. I want to expand some more within Colorado. So we've got lots of great plans, and our staff is acclimated, and we're here to stay.
So, with regards to the acquisition criteria, going back a little bit, just okay. So Texas, Colorado. You mentioned California, even when we talked, that you were working on some deals here in my state. So, is there a profile? You mentioned the Texas and Colorado. Is that in the Texas? I understand with the taxes and the regulatory environment. Colorado, is it because you currently have a footprint there, or you see something in that economic climate that you like?
Yeah, a lot of us economic climate. So for Denver, for an example, I mean, we're just closing our 7th store in Denver next month. So that in under a year, that'll be 7 stores, and we're looking at a couple more as well. So you look at Denver and the growth potential in the greater Denver area, as well as going south to Castle Rock or even Colorado Springs.
Right.
It's the sky's the limit. I mean, I think look in Castle Rock alone, between I think about a year ago and a year and a half from now, there's 4,500 new homes being built. So it's going to be a huge spaceport, big tech port. So there's a lot of really strong growth going on. So that was a big part of our philosophy with that. California, it was a matter of really the brands kind of fit the area that we wanted to be in. And I'll be honest, I mean, California wasn't our first choice to begin with, but the brands made a big difference for us, and the growth opportunities that we saw in those particular stores.
So,
but the rest of them, we got stores in North Dakota. North Dakota was our second group of acquisitions in the U.S., and it's a little bit like home. It's a lot of oil patch up there, a lot of farming, some mining, and
right.
a Chevy store and a Subaru store. It was a great fit for us, and we've done very well. We got a great managing partner, Terry Weisner, who was our fixed operations director up there. He's now our partner, managing partner. So it's that kind of fit that makes a difference for us.
So, with regards to brands, I noticed you've got a lot of domestic stores, and a few imports. Is there a appetite for all brands, or are you more domestic, or are you thinking luxury, any kind of high volume Asian brands? Is there? Tell me what you're looking for.
Phil, it's really got to fit in our wheelhouse of multiple. So if it extends beyond our expectation of multiple, we just won't buy it. So for an example, I'll give you an example for Canada. Subaru stores are selling for 11, 12 times, and I won't even open the second page. So we got to make sure that we're buying them at a fair multiple. So that criteria has most to do with it. And then secondly, I mean, who doesn't want this? But you want to make sure you pick the right brand in the right market. So if we're in rural Texas or in rural North Dakota, we want to make sure that we've got a good domestic brand, particularly truck brand. And in the case of Subaru, you got an all-wheel drive car that just exponential growth has been incredible. So we're really picky, with the exception of maybe some larger groups that we're looking at, because sometimes you got to take the good with the bad, so to speak. But we're very particular about what brands and what market. So
I know I've asked this and you've answered it, but I got to ask a little more. I'm curious because are you looking? Well, I didn't ask exactly this, but broken stores or turnkey profitability?
We like to say bent, not broken stores. Because broken ones are really
slightly
tough.
Used, slightly.
Right. Just the willow's just about to snap, but it hasn't snapped yet. So, and having said that, we bought some stores that aren't like that. We've bought some stores that are really good stores. So, ideally, you want to look at something that's going to have that upside, as I'd mentioned. And sometimes, I've got most of the guys are like really good friends of mine, and we talk really on a weekly basis, and we've got a lot in common. That has a lot to do with me going up there early and getting to know them and developing a relationship. But a lot of guys just said, you know what, one guy in particular, I won't name his name, but he says, I just ran out of runway. I was a great dealer, time dealer of the year. I was kind of the envy of the car business. I've had enough. I don't have a succession plan. I want to move on, and I want you to succeed. So those are real good scenarios for us as well.
So would you say that you are, well, let me just ask it this way. How does technology these days? And oh, wait a minute. Let me digress for 1 second. Would you say that your organization, the way you structure things with your partners, would you say you're more centralized or autonomous? Do your general manager partners operate within kind of a corporate structure, and or are they basically, do they run their own show?
I would say that we're more centralized. We do have definitely, a lot of autonomy, but there are things that, between deals you have with certain vendors, you want to ensure that you've got the best pricing, and you want to have, scale makes a big difference, obviously, right, when it comes to pricing. Right. So we ensure that happens, and we got really strict policies, and we got real strict procedures as well. That you talk about CITs, or you talk about aged work orders, or work orders aren't closed, aged used inventory, aged new inventory. We've got. Let's just say there's no guesswork. You know exactly right where we sit as far as what our expectations are. So, and that's if you have, if I was to look at some of my, I'd say more, double A personality partners that we have, that's what they'd expect as well. So we're not, by any means, we're not overly strict, but everybody knows kind of what the expectations are.
Well, do you see yourself, like, I'm thinking about your group as a whole, would you say that is technology playing a larger role today as opposed to 12 months ago with COVID, digital retailing, and what have you, and pickup and delivery? Are you seeing that kind of a trend in your stores?
Oh, certainly. We're at the forefront. Like we've got some incredible AI technology coming out right now. We've got some really good marketing strategy when it comes to lead development. Just driving a bunch of data towards our stores individually that could come to the tune of 30 to 40,000 new customers a month, just so we have access to over the next 3 years. Times that by 36 months. We've got some stuff we're working on right now when it comes to used cars. The AI pieces I'd mentioned is huge. Tell
me a little bit about that. That's people toss around AI and machine learning these days like popcorn, but it sounds to me like you have a serious initiative. Can you describe it, or is that like secret sauce stuff at this point?
No, we're to the point now that we're going to be launching some stuff early next week, and then we'll probably go to market with it in the next little while. But it's about really funneling. It's not, our intention isn't to be a marketing company for other dealerships. We want to make sure that we funnel the proper leads to our own stores, and then also give that opportunity to external stores. So rather than having a BDC center that's sifting through 2,000 leads, which maybe only 200 or 300 are buyers. We want to make sure that we can siphon those down close enough that now we've really whittled them down, and now we can start, instead of machine learning, now we've got individuals dealing with the people. So it keeps your costs down. We're not spending a bunch of money on us trying to be the marketers for you or for ourselves. We're just depending on, let's really take that quality lead and do our best with that quality lead, as opposed to really spreading ourselves too thin. And then we got another thing that is a little bit secret sauce right now that I can follow up with you someday on. That's really, really exciting.
I'd love to hear more about it. Off the record, there, that is. Question: are you using in your stores? Are you using any kind of a enterprise reporting system to, again, you start managing things? And I know you're talking to your partners and what have you, but I'm curious as to what dealers are using for the management, of their stores. Like I said, tremendous growth, 21 stores in 2.5 years. how are you? What are you using at the enterprise level to manage the stores?
So we've got a bunch of different DMSs because we adopt some obviously when we do the deal, but we're
Right.
switching all to one DMS system, which we're starting to have most of our stores switched to now. And out of respect for your key sponsor, I won't say who it is, but as far as general management or consolidation, we use Accessa, and Accessa has been a great
Sure.
tool for us because we go in and we can measure absolutely everything. I mean, you talk about the notes on a CIT or an open work order, finding out your aged inventory. So it's a Bible for us for sure. So that's something we depend on. And also we have our own internet that we just started, when it comes to communication, but plus some reporting. We do daily sales reporting, a little bit of an attaboy type thing or attagal. When somebody has a great day or a great volume day, then everybody can chime in and congratulate people. So we do stuff from internal thing with the internet, but we also use external with the Accessa, and we're developing some of our own stuff as well. We've got great consolidation reporting. We've got a very robust accounting system within our head office as well as the staff that support it.
So you mentioned with your partners that they share in the real estate. Can we speak about real estate for a second? So a lot of dealers I work with, they've got a preference. Most would like to own the real estate. Some have to own it. It's just part of their profile. What is your situation with real estate? And do you have to own it? Want to own it? And can you speak to your appetite for CI Capex expenditures as well?
Well, we own the majority of our real estate. We just recently did a big deal. We didn't buy real estate, and we looked at it from just really a free cash standpoint. Are we better take that free cash that we would have spent financing a large amount of money for real estate, or do we spend that money to buy some free EBT from new opportunities? And we chose to go the latter. But majority of them we do own our own real estate, so we prefer to do that. It really depends on the dollar value of the real estate. But from a cap rate, our caps range from as high as 8.5% down to 6%. So really depends what market we're in. And again, we kind of dictate our own cap. And as far as capex generally, we allow about $150,000 per rooftop annually for capex, whether it be hoists or just your general odds and ends. Some of the stores we just bought, we went in, we spent $700,000-800,000, but we knew that prior going in, so that was part of our purchase philosophy, was to make sure that we had the right amount of hoists and alignment machines and whatever else we needed for the shop to ensure that we had the right equipment to do the job.
Do you incorporate the capex into your calculation for a return?
We do, yeah.
Yep.
Yeah, we calculate everything imaginable. We've got. I know you're an ADMA guy, so you'd be quite impressed with how diligent and how thorough all of our information is. It's very impressive.
Yeah, it's always interesting to see how people approach it. I mean, you can imagine. Well, you've got your own experience in the M&A space and investment banking world, and so it's the kind of the full spectrum from like a cocktail napkin to like robust due diligence. And anyway, I think that
I'll be honest, Phil. When we sold the one of the dealerships in 2011 to really good friends of mine from my dealer 20 group, and our PSA was or APA was a page and a half long. So I really miss those days.
Really?
I wish we'd get back to them.
I've seen short ones.
Yeah, and now they're not. They're like, what are they? 100 some pages long.
Yeah,
plus 100 appendixes.
So, tell us. Let's have a little fun here before I let you go, and because this has been great. Tell me something that people who know you, Kevin. Tell me something that people who know you don't know about you that they'd be surprised to hear.
Well, let's see. My wife's always surprised that when I was young, I rode the rodeo. So that's something
what?
that I rode in the rodeo when I was a young guy. And,
Calgary rodeo. That's a big deal.
No, I wasn't good enough. I wasn't good enough to ride in the Stampede, unfortunately. But I did have one of my best friends did, and his uncle was like 7-time Canadian bareback champion. So he was one of our idols growing up. Yeah. But that was no. I guess my proudest are my 2 kids and my 4 grandkids. So those are the things that are most important to me, and as well as my wife, obviously.
Obviously, awesome. Well, I think that's a perfect place to leave this. And before I let you go, tell us, kind of how people can reach you. What's the best ways to get in touch with you?
Well, if somebody's looking at a partnership opportunity, and they might have something kind of in their back pocket they're looking at, you can always reach me at kevink@foundationauto.com. Is the easiest way to do it. And I obviously can't step on your toes when it comes to acquisitions, but also feel free to email me if you have something in the hopper for that.
Or email me. I'd be happy to make the introduction. So
yeah, absolutely.
All good. So before, I can't thank you enough, Kevin. It's been great to get to know you and know your story and foundation story and continued success. I wish you all the best going forward, and let's stay in touch. And before we sign off here, just our audience, please hit the subscribe button next to down below the screen, and hit the alert icon as well. You'll get notified when we have a new show going live. So without further ado, I'm going to say thank you to Kevin. It has been great to have you on the podcast, and thanks to our show's sponsor, Techion. And remember this: don't take any post-dated third-party out-of-state hold checks. I'm Phil Vogel. See you next time.